Okay lang. Basta iwan mo lang naka-on. Iwan mo lang naka-on. Oo, tapos ako nanonood. O yan, naka-record na. Pwede mo may edit din mamaya, no? Live na nga. Lakas ng water. Saan pick up ng mic? Okay, guys, good morning. It's about 15 minutes before the open of LSE, and we are okay. Let me just figure out where that loading is coming from. Alright folks, so I guess we can get started. So it's a fresh week, the first week after a very tumultuous one. Last week we had President Trump announcing Liberation Day. Basically, he tariffed almost everyone around the globe. Now, they did some tricks as far as this tariff is concerned. They wanted to sound scientific about the process, but people caught on, and they figured out that Trump was just looking at the trade balance. Anybody who had a positive trade, who had a trade surplus with the U.S. was slapped with a tariff. Now, as far as the markets were concerned, the immediate reaction was to dump practically all assets. Okay, whether you're talking equities in Europe, equities in the US, whether you're talking real estate or you're talking technology, you're talking services, you're talking industrial companies, almost everyone was down. And this is basically the result of the growing fear that we may have a 21st century recession happening. Okay? A lot of people are now looking back into history, and they are pointing out that the Great Depression in the US was essentially caused by American tariffs. All right. Now, if we look at the markets today, what do we have? Look at commodities, everything's in the red. Well, almost everything. I guess your winners would be your haven assets, although gold seems to be down a bit. It was in the green earlier. Silver still in the green. Surprisingly, you've got soybeans and wheat. Well, people have to eat. Whatever happens, people have to eat. What else do we have here that's interesting? Note how much oil prices have dropped. Okay, crude oil, gasoline, heating, essentially energy. Why are these assets down? Well, let's put it this way. If you have a recession going on, energy assets are the last thing that would be safe. People would be traveling less. People would be consuming less. And remember, people might talk about EVs, people might talk about the digital age, but everything is still run by energy. Your data centers need air conditioning, and that means you need energy. Okay? So, obviously, your energy commodities are down. If we look at stock indices, we are practically in the red everywhere. Okay? US futures, Asia, look at Japan. Japan's down by almost 10%. And who's okay? Who else is seeing significant losses? Well, we have Italian markets open already, and they are also down around 7% right now. China's down 8%. Of course, the Chinese were slapped even more tariff. They they did retaliate to the U.S., but at the end of the day, this still means that a Chinese economy that is badly in need of an export market is practically down at this point. Okay. So what else do we have here, guys? Let's take a look at the individual stocks and look at what's happening to Tesla. Down by another 21% in followed by most of your other tech stocks. So again, this is Tesla, I would say this is a reflection of Musk's influence with the Trump administration. This is really more, well, okay, let's put it this way. Yes, you've got BYD, you've got the Chinese EV makers really catching on to Tesla with respect to design, with respect to technology. But a great part of the decline of Tesla is really people, it's just backlash to Elon Musk. Now let's take a look at currencies. So what do we have? It looks like nothing much has happened. I mean, you've got some pairs there that are in the red, some in the green. Your commodity pairs are in the red. Aussie, New Zealand dollar. Surprisingly, Canadian dollar is also down. It is, after all, indirectly coded. So yeah, your commodity currencies are losing at the moment. You actually have, I guess it will be a lot clearer if we'll take a look at the charts. So let me drag down some charts and let's take a look at this. Let me just shift to dailies. Alright, so what do we have here, guys? You will see that we've had an active trading day already as far as euro is concerned, as far as cable's concerned, Swiss franc, dollar, Japanese yen. You look at Canadian dollar, okay, so far little trading has been happening, but of course you have to think about it. I mean, Canada and the US are in the same time zone, so there's not much call for trading USD CAD during the Asian session. What do I find interesting here? Well, folks, data wise, okay, let me get back to that calendar a bit. Let me just drag this calendar down. So, other things that surprised us last week was, despite all that firing, that job cuts that Musk was doing last March in the US, your non-farm employment change numbers were actually surprisingly strong. 228,000 against 117,000 consensus forecast. So this was a surprise to the market, and on Friday, this actually led to your dollar gaining ground. Look at this sharp drop in your AUD/USD. Nice pullback in euro. Big sell-off in cable. In fact, cable, we actually found it closing right around the consolidation floor for the last 2 weeks. Of course, it's opened the week below that, given tight liquidity, and now we're back inside this consolidation for the past, I would say that's actually the past 3 months, or rather the past 3 weeks. Okay, let's find something to trade though. Is there anything that we can do today? Is there anything that we should be aware of that's happening today? Well, let's look at the calendar for today. Let's look at the calendar for the week. Is there anything worth watching out for? You have inflation data from the US on Thursday. You've got consumer sentiment numbers on Friday. For today, looks like clear skies as far as market moving events are concerned. Wednesday, you've got, okay, for Kiwi traders, you've got an interest rate decision, and looks like we will be expecting a rate cut on Wednesday. Well, we'll talk about that tomorrow. For now, let's focus on today. So nothing in the calendar that I find exciting. Okay, these are mostly country level data out of the Eurozone. So if I'm not expecting any catalyst, then I will always fall back to technical analysis. I will always fall back to the charts. Basically, if you're an economist, you would know the term ceteris paribus, meaning holding things equal, holding all things equal. And without data, we hold all things equal and we stick to what the charts are telling us. So let me start with euro. In fact, typically for me, I actually prefer trading just euro. Why is that? Because essentially, euro to me is one of those safest currency pairs to trade. You've got high liquidity in EU or USD. You have tight spreads because of that high liquidity. And data-wise, for the most part, you only have to look at what's happening in the US. Now, we call our live trading session Big Ben trading or London Open trading because we want to trade with liquidity, and EURUSD is the most liquid at the open of the European market and at the close of European market, which is also the time when the US opens. But what is euro telling me right now? Okay guys, let me go to the daily charts. So here's our big rally following Liberation Day. Let me just open my pen. Okay, so here's that big rally during Liberation Day. That was followed by a sell-off on Friday, given the stronger than expected US jobs data. And guys, I would also note that one common phenomena in financial markets is that people tend to close their trades on Fridays. What do we mean by this? People who made money buying your euro earlier in the week, people who made money Monday, Tuesday, Wednesday, Thursday, if there was a trend, would close those trend by Friday. Few traders would want to have an existing open trade over the weekend. A lot of traders would just want to have nothing to think about during the weekend. They would just want to relax, and you only do that by being market neutral. And in instances where you've had a big rally, there's a tendency for people to close their trades, and if you have data which reinforces the idea of better safe than sorry, better to take your profits now than have to give back everything back to the market, then Friday you'd expect that a pullback happens. All right, so what do we have? Normally I'd love to be active during this session, but one of the worries that I have right now is if I look at our ATR, okay, I basically switched ATRs because the market has been so active Friday, Thursday, that I'd like to capture that level of activity, which means that I adjusted my ATR to a 3-day sampling period. Normally, I would use a setting of 21 days in my ATR, but for now, I just want to see what's been the average range for the last 3 days. And the numbers are about 223 pips. So that's pretty big. Normally, I'd expect your euro to trade between 70 to 90 pips a day. In fact, if we change that ATR sampling period, let me just do that. If we change the sampling period to 21, why 21? Because there are 21 trading days. We change it to 21, and okay, you've got the average daily range at about 0098 or 98 pips. But like I said, it's been so active the last 3 days, the last 2 days, that currently it's on the 200s level. So for today, how much range do we have already? We have highs at 1022, lows at 0879. So we've actually had about 140 pips of price action. And again, my thing is, I don't like it when I'm trying to chase the market. And okay, at this point, you've had 140 pips of price action. Average daily range is only 98. The average for the previous 2 days is about 200. So we don't really find ourselves in a very nice position as far as our usual breakout trading strategy is concerned. Normally, I'd love to do a breakout trading if I am presented by a consolidating market during the Asian session. Okay, so if I were given something like this during Asian session, this during Asian session, I'd love to be able to. I'd love to do something about that. But if you've already had an ongoing price move, and that price move has been significant already, I'm a bit concerned about trying to catch such breakouts. So what am I saying? I'm saying that much as we think that there's been a change in the market structure for euro, much as we think that your euro should now be looking at testing the 1.12 area, I don't think that we are in an immediate position to take action. I don't think that we should be taking action anytime soon. So what's our plan? Well, if I look at our chart, one thing with technical analysis is there's that tendency for markets to test previous extremes. And we have these highs here from back in August and September around the 1.12 region. That's our target. That's our objective. Try to get to that level. And I really wouldn't be too interested in shorting your euro until I see these price levels or until I find myself with reversal signals. That's not happening anytime soon. We may have had a pullback last Friday. We even gap lower at the open, but this is not a market that I'm willing to short. For now, my bias is to just take the buy side. If I had a consolidation during the Asian session, which I did not, I would have thought of doing a straddle. So what about now? Well, guys, if you really have to take a trade, I would say that we can use a break of the day's high at 1.1022. We could use a break of that level as an entry point. Okay, very simple strategy when you're trading the open of let me change that. Very simple strategy to use at the open of the London market. Look for breakouts. Given the extent of the price action that we've seen, I am not very keen about joining this breakout, particularly since I am still doing my evaluation phase for a single phase prop account. I have to be very careful. Typically, single phase evaluations use a dynamic drawdown, so I can't really afford to tolerate losses. So will I buy at the break of this? What are my considerations? We've exceeded your average daily range for the past 21 days. We have about 140 pips of price action already. So I'm concerned that if I join the buy side at a breakout now, I may not have enough momentum should that happen. At this point, I only have one preferred way of taking the buy side, and that is if I get a little bit more pullback, if I get a hammer. Okay, let me just draw a hammer. If I get a hammer, okay, if I have a bit of a pullback and then I get a hammer in euro, I don't really care at what price, okay, because I know that this is a European session. I know that the market will be active. Then a pullback and a hammer, preferably, of course, if that hammer is coming from a support, then I'd be joining the buy side. But to chase this breakout now, when you don't have any catalyst in the market, your key event for EUR/USD will be on Wednesday. Sorry, let me just double check that day. When is CPI? CPI is happening on Thursday, so yeah, key event will be on Thursday. So not doing anything, sorely tempted. Okay, we're actually breaking the highs now. I'm sorely tempted to join this, but we have to be disciplined. It's moved by a lot already. There's no reason for markets to be very active today. So I'm gonna skip this one. Will I consider selling? If I were to get an inverted hammer, that to me would be a good excuse to sell. look for a pullback. Say there's some hesitation in the market. What are inverted hammers? Well, let me show you some examples. So this is an inverted hammer. This is an inverted hammer here. So if I had something like that, then yeah, I might consider selling. But again, our trend is going that way. Okay? Our overall trend is bullish. We have that target at 1.12. And the safest way of doing anything is to just join the buy side. If we had a consolidation earlier and the range was tight, then we can consider taking a straddle. But at this point, no. Again, better safe than sorry when you're trading. Sometimes a decision not to do anything is actually a trading decision. So there's an ongoing attempt at the breakout. Our problem with that is we don't really have any catalyst to drive that further. We've had a big price action already. So let's move on to other stuff. Maybe we can find opportunities elsewhere. So let me take a look at cable. So what's going on with cable? Like we said earlier, we've had that big sell-off Friday. We closed just above the 3-week consolidation support. We opened below it, we covered the gap, and now we're back in. All right, what are the things that I want to know before I do anything, before I take action? Well, let's take a look at average ranges. So let me see the ATR of. By the way, I don't really trade cable that much. I mean, like I said, I like trading. I like trading your euro. I like things simple. Average daily range for the past, using a 21-day sampling period, is at 94 pips. Okay. All right. So 94 pips average trading range for the past 21 days. If I look at it from the perspective of the last 3 days, Thursday, Friday, today, it kicks out to about 201 pips. What's the range so far for the day? 29.31 for the high, lows at 28.24. So we've had 110 pips of price action. Again, not so attractive a proposition. But what else are we presented with? Let me go intraday. We have a nice double bottom in our hourly charts. All right. So, okay. We've got a price pattern. What else can I argue? We have pushed back inside the previous consolidation in your daily charts. So let me just put the support there. So we pushed back inside this consolidation. I think over the coming days, we are likely to just see this market trying to reestablish a trading range. Okay. All right. So what are we to do then? Well, let's put it this way. If as a trader, you're typically trading intraday, you don't hold positions overnight, then again, I'm not keen about taking any action. But if you're the kind of trader who can hold on to a position overnight, knowing that this is going to get triggered, we are going to probably establish some form of consolidation in GBP over the next few days. So this is actually a good buy for me. How do we play this? How do we trade a double bottom? Well, get the distance between the lowest point and your midpoint, whatever that is. project it once there's a breakout. Okay, so let's just say that this height is A, so project that A prime, and yeah, that's one way of trading this. Again though, I would remind people who want to take this trade, this is not at this point an intraday trade. As far as when I look at this, I don't think that this is a simple intraday trade given the extent of price action that we've seen already. We've had 110 pips of price action. If you do take this, how do we plan your trade? Yes, your target should be around here. You have a high here, and then again, that's also roughly the distance between your breakout point and the lowest point of your double bottom. By the way, we are using C-Trader, so that means that you have a built-in partial profit algo. So if we were to take this trade, we'd take some profits as we hit this area, and then as we hit this region. So we could break our trades. We could give it different take profit points. If I were to trade this, where would be my stop loss? Here's the thing, guys. If this, okay, let me erase this. It's getting a little crowded. So if this double bottom here were occurring from a tight range for the day, meaning if we've had just under half of your average daily range, then I would be excited about just jumping in and then put my stop loss below the lowest point. But given the distance already seen for the day, you'd be exposing yourself to 110 pip risk. So not exactly an ideal situation. Other places for you to consider as a stop area. Well, this is the lowest point of your chart. This is likely to lead to a fractal pattern at the close of this candle for the R. So we can consider we can consider putting a stop for any buy that we take now just under the 2880 area. Numbers wise, 2880, your breakout point will be about 2933. So you're actually talking about 53 pips of 53 pip risk. So how do you compensate for that? Well, one way of adjusting for wider, bigger daily ranges is for you to reduce your trade size. Okay, now let me show you something. Typically, I would have used 3 lots on a 50K account. Okay, I'm comfortable with that. Okay, my brain works with that number, with the numbers that comes out of a 3-lot trade or even a 4-lot trade. But I would use that kind of lot size when the market is giving me average ranges or ranges that are equal to the 21-day ATR. Meaning if the usual trading range of 90 were happening right now, then I'd be happy to just do that full size. But when you find yourself in a situation where the market has become volatile, where the trading ranges have become bigger, you would have to think about adjusting your trade size. So I would suggest that if you do take this, reduce it to about half of your usual uh, trade size. Remember, putting your stop loss is not just about controlling the dollar amount of losses that you're willing to take. It's also about trying to get a good price point for that stop loss. What do I mean by this? Okay, so some people, some traders, they would just use a ratio. They'd say, okay, I'm willing to I'm willing to lose, let's say, a hard dollar figure. I'm willing to lose $1,000. I'm willing to lose $500 for a potential $2,000 profit. Now, it does make sense when you talk of it that way. Potential upside is about twice of your potential downside. But when you're dealing with a market, you have to consider where are the places where you should be putting your stops. Where are the places where you should be joining the market? So, in this case, if I were to join this, if I were to join this double bottom right now, when it breaks, when the market has already moved 120 pips, 110 pips, okay, that's just too big a risk for me. So I want to minimize the potential dollar losses by reducing my trade size, and I'll be placing my stop loss not at the ideal level of below the pattern's low, but below this low, the low from our previous R, okay, which will likely turn into a fractal pattern at the close of the R. So again, nice double bottom pattern, but not something that we should be excited to jump into. Okay, what else should we be looking at? I think people have been very interested in gold. Let's add gold. Alright, so what happened with gold? So even before President Trump's Liberation Day, you've had that big rally in gold already. Since then, we've actually had a surprising pullback. One would have expected that, given the amount of turmoil, given the sell-off that we are seeing in the equity markets, we should be seeing even more new highs in gold prices. Well, I think this is really in part a reflection of your buy the rumor, sell the fact idea in the market. Even before Liberation Day, you've had your gold prices rallying to new historical highs already. But what about now? What do we do about this? We sold off Friday. We actually sold off earlier in the Asian session, but we are back above our consolidation floor from 2 weeks back. Alright, so what do we do then? We're saying that we are back above this consolidation floor from before. It looks to me like your daily sell-off has lost some momentum already, given that high wave candle that's now forming in our daily chart. Okay, when we say a candle is high wave, basically we're saying there's a long wick, there's a long tail, and a small real body. So that's what a high wave candle is. So high wave candles are a sign of lost momentum. Okay, so you're saying that the pullback seems to have lost momentum. We are back above the previous support area. We are not in a position to do any anything immediately. Let us go lower time frame. Lower time frame, what am I being presented with? A lot of indecisive candles with the previous 2 Rs. What else do we have here? We have this long candle here. I think that's about 0900, well, in my time. So that's around 0100 GMT. Open of Hong Kong. Why is that significant? A lot of gold being bought in Hong Kong. Okay, Hong Kong being a primary market for physical gold. What else do we have here? Can I say that we are forming a flag pattern? Yeah, it can be argued that we are forming a flag pattern. Okay, I guess something that I have to point out, the big difference between gold and your currencies. Currencies tend to have a natural cycle on when they are traded. Okay, currencies like your yen become active during the Asian session, and if paired with the euro, becomes active again at the open of the European markets. Metals, however, tend to be different. Gold, however, is different. Okay, you can't say that there's a natural market for gold because gold is not tied to any single economy. Okay, unlike your yen being tied to Japan, or your Korean won being tied with Korea. So meaning gold is traded by almost everyone everywhere. So unlike the currencies, even though we've had a decent level of price action already, I tend to think that gold is something that I can still trade given a nice setup. Do we have one? Indecisive candles. Actually, this is a nice setup. I normally don't use this because I really just prefer sticking to your euro. But let me just drag my pen. We have a consolidation. We have indecision in gold. So what's the plan? Well, at this point, I'm willing to take things either way. Give me a solid close above this area, and to me, that's an entry point. That's an excuse for you to say, I'm going to look for gold to push back up to its historical highs. Give me an hourly close below this level, and let's give a number to that. Let's not just say level, but let's get a number. So give me a solid close below that 3014 area, and I would consider that as an excuse to short. I would say that gold, having had a very nice run the last couple of months, is still due for a further pullback. By the way, if you look at your chart, gold should actually be looking at testing this region, this consolidation resistance from February. So it looks like we're not able to take any immediate trade in this session, folks. My problem really is that we've moved so much already with your euro, with your GBP, that I am unwilling to take action. Not at this point, not without any fresh catalyst. Gold, like we said, is a different story. It's a question of the market giving me the breakout that I want to see. So allow your gold to consolidate, get a close above the day's high at 30.55, and that's an excuse for you to go buy. Get a close below your 29.69 area, and again, that's an excuse for you to sell gold at that point. So, folks, I guess we'll just wrap things up for now. Thank you for joining us for this pilot session, and I hope to see you next time. Thanks, guys.